Hey everybody, welcome back into Mining Stock Daily. Trevor Hall here with your Friday long form episode. We've got I'm going to recommend actually watching the YouTube video on this one because we've got Kevin Wadsworth of Northstar Badcharts with a walkthrough of everything he has been seeing in precious metals, the markets, and volatility. And we kind of step back to some of the forecasts that he shared with us some months ago, where we're at now, and where he sees us heading to potentially in the next coming weeks and or months. It's a great visual representation of what is happening in the markets with all the graphs and forecasts he's been sharing on Twitter, but he really opens up the commentary with us here on Mining Stock Daily. Special thank you to Visa Silver, Arizona Sonoran Copper, and Fireweed Metals for your continued support of the podcast and allowing us to continue to provide this content. And as always, please leave a like, review, and share this content. This is an important episode. A lot of visual representations here from Kevin. In fact, I'd kind of sit back and just watch in awe, to be quite frank. All right, let's jump into it. It's an important one. Have a great weekend, everybody. All right, good morning, everybody. Welcome back into Mining Stock Daily, and we're going to talk a little bit of technical analysis, welcoming back a previous guest. It's been a while since we've had Kevin Wadsworth from Northstar Badcharts on to Mining Stock Daily. I think the last time I was probably about $600 or $700 ago on the gold price, and we've obviously had a nice move since then. And I remember those forecasts vividly, Kevin, and so I just kind of wanted to get you back here on the podcast, talk about where we've come from and really what you're seeing here in the in the coming months, and then also maybe into 2025, because you did an excellent job of forecasting these price movements of precious metals. So I think it's just time to get a thorough update. So thanks so much for your time here today.
Yeah, sure. Thanks, Trevor. I realize a lot of people watching this might not be particularly familiar with technical analysis. So whilst I'm just talking about this, I'm going to share the forecast that you're referring to there. This forecast was put out back in 2019. So the last time we spoke, we were looking at the sort of culmination of this prediction or this forecast. So this chart, you can see, starts in 2019. That's where the price was when I issued this forecast. And the forecast was for the gold price to approximately follow these green arrows. I was just bringing together a whole load of technical evidence, sort of weight of evidence that we use. And those green arrows gave a very simple summary of what I expected the gold price to do. Now, over the last few years, of course, gold price has moved. You can see how it's moving there, following the geometric arc back to those previous all-time highs around $2,000. And as everyone's aware, we had a very frustrating period that lasted several years, in fact, from the peak in 2020 to the recent breakout. So there you go. You can see the price action on that chart just moving away whilst we're talking and heading towards the top right-hand corner of that arc. And for people that haven't seen this type of technical analysis before, it brings together a range of pieces of evidence when you're trying to weigh up what's going to happen with a stock price or the price of gold and silver. You need to bring together a whole load of evidence, and some of it's contradictory. And there are certain points in time when the evidence all sort of points in the same direction. And as the forecast progresses, as you can see this one progressing, we had to keep reanalyzing the forecast to make sure that there was nothing fundamentally changing that altered the weight of evidence. Things, stuff changes, stuff moves, the evidence is coming in all of the time. So when I say evidence, I'm talking about what's happening with the stock market, what's happening with interest rates, what's happening with the yield curve inversion, for example, what's happening with the broader markets and where the ebbs and flows of capital are leading us, because the precious metals market is very, very much dictated by capital flows. It's dictated by cyclical behavior of funds that slosh around between primarily stock markets, general equities, and precious metals and commodities. And they move in cycles. And so there are points in history, like right now, where you see on this graph just unfolding in front of you, where the price began to move out above that horizontal resistance zone at the back end of last year, late 2023. And when we started getting the price action just starting to move above that resistance zone, which you can see on the chart there now, that was the point where we became highly confident that the forecast was panning out as expected. So we got the cup and handle pattern, we got the breakout from the handle, and you can see where we are now, roughly sort of $2,500 in that region between 2,450 and sort of 2,520, 2,530. So moving forwards, that basically is the completion of that forecast. So when we last spoke, the forecast was still to be completed, and to all intents and purposes, that particular forecast that was issued sort of 5 years ago is now complete. So we need to update it. So the updated gold forecast is this one here, and people that follow me on social media will have seen this. And this is the new gold roadmap, which takes into account that cup and handle and the handle breakout. And you can see the targets here anywhere between 2560 and sort of 2690, $2,700. There's a lot of technical evidence that points to the 2700 area. We've got, well, I was going to say I've got fairly close to that. I've certainly got fairly close to the 2560. In fact, I think we just about reached the 2560 level. What was the high on that candle there? It's 2570, in fact, on this gold futures chart. So we've reached what I would call profit-taking area. Profit-taking zone is anywhere between 2570 and 2700. Of course, there are lower probability scenarios. This chart represents what I consider to be the highest probability outcome, and really it splits into two. It's either we peak now, drop, and then break out into a much larger bull market, or we make the breakout now, back test it, and then off we go. So the question is, do we burst out beyond the sort of $2,900 area and move up into the low 3000s before backtesting, or do we hit this 2700 area, which to all intents and purposes we're at now, and then pull back to the 2100 area before a blast higher? Now, a lot of that centers around what's going on in the broader markets. So the evidence for what is going to happen next hinges on broader markets. I know we've got an important event taking place in the US at the moment, the Jackson Hole meeting, and no doubt some signals coming out of that in terms of interest rates and interest rate decisions. But it's not really that narrative that is particularly important when it comes to where precious metals are going. And gold and silver react and have knee-jerk reactions to announcements like interest rate decisions and to things like major escalations in global conflict, but it doesn't determine the longer term direction of gold. The longer term direction of gold is determined by capital flows and also weight of evidence, as I've mentioned. So we can make some conclusions about what's happening with the gold price at the moment. It's breaking out versus inflation, and gold breaking out versus inflation is a precursor. It has to happen in order to have a gold bull era. Not to be confused with a gold bull market, because we are in a gold bull market, but a gold bull era lasts typically sort of something in the region of 10 years. And the reason it happens, and it happened in the 1930s, it happened in the 1970s, and it happened in the early 2000s. The reason it happens is because the stock market has had a massive pullback, and the flow of capital out of stock markets finds a home, and that traditionally and historically is precious metals and commodities. So that rotation of capital, which we can see in many of the charts, you can see it on this money supply versus gold ratio. Again, it's a precursor that this chart breaks down to allow a precious metals bull era. This chart is telling you when it breaks to the downside that gold is so this is USM2 to gold. So when it's rising, money supply is outperforming gold, and when it's dropping, gold is outperforming money supply. So when you get a breakdown, you get a topping pattern and a breakdown. That's the bear market bottom for gold, and we saw that quite a long time ago, actually, in early 2023, early last year, and we got the breakdown. So this was a leading indicator, and I suggested at the time that it was quite probably going to lead to a significant run in gold. But this was just one piece of evidence. So the confidence levels were not particularly high, But when I suggested that that was likely to be a bottom, with hindsight, we now know that it was. And when I put this label on the chart saying that a move of several $100s seemed likely, well, you know, we've moved something like $800 since this chart was issued. So that particular piece of evidence fell into place. Another piece of evidence is gold versus the US dollar index. Now, this might be a bit tricky to get your head around because it's the US dollar index. It's not the US dollar, it's the US dollar index. The US dollar index, DXY, is the US dollar versus a basket of currencies, primarily the euro. So this is gold versus US dollar index, and the US dollar index is the relative strength of the US dollar versus primarily the euro. So what this chart is telling you is that gold, when it breaks out to the upside, gold is outperforming any strength that the US dollar might have versus the euro, and that's clearly bullish for gold. So if gold is able to be stronger than any relative strength the US dollar has against its peers, primarily the euro, the pound, the yen, and the Canadian dollar, I think it is, and a couple of others, then that is another indication of a precious metals bull era unfolding. You can see way back here in the 1970s, it broke out and gold massively outperformed the DXY and the US dollar strength versus its peers. The same thing happened in the early 2000s. We formed a bullish pattern, broke out, and that led to gold doubling, and then it doubled again, and then it doubled again. And we've just broken out again from this bullish pennant pattern. So the likelihood is that gold is going to double, then double again, and then probably rise some more. So we're talking about 2,000 to 4,000, 4,000 to 8,000, and then probably a little bit beyond that. That's the historic suggestion from that particular piece of evidence. But the main piece of evidence, the major part of capital rotation is this chart. It's gold versus the S&P. Now, that we are not going to get a precious metals bull era until this chart breaks out. You can see it did that in a very dramatic fashion back in the 1930s. It did it in a more leisurely fashion in the 1970s, forming an arc-based pattern, a geometric arc, which guided the ratio into a breakout. And when it breaks out and rises, it means that gold is outperforming the stock market. Okay, when the chart is dropping, it means gold is underperforming the stock market. So you can see a very clear cyclical behavior here. So gold outperforming stock market, gold underperforming stock market, outperforming, underperforming, outperforming, underperforming. So the suggestion here is that we saw a huge breakout in the early 2000s, which led gold to double and then double again, and then it rose some more after that. It doubled from 250 to 500, 500 to 1,000, 1,000 to 2,000. So it doubled 3 times. And then what we've seen is a decline, but it hasn't come all the way back to where it started. This is a pause. This is a likely pause in an ongoing bull market. And when you look at gold, the gold chart itself, it held a corrective pattern rather than breaking into a major long-term bear market. So really this chart suggests that this has been a corrective phase in an ongoing bull market. And in order to confirm that, this chart has to rise above this 0.5 major support and resistance level. And if it can do that, then I think the probabilities become much stronger that we are entering the next and sort of final phase of this ongoing bull period that started back in 2000. So it could well peak in the late 2020s or the early 2030s, but a number of years of an ongoing precious metals bull market. And this is capital rotation in force. We all know the stock market's been doing great, but actually if you look at this chart and you zoom in, this ratio chart has been going sideways since 2015. The ratio in 2015 was 0.5, and it's quite close to 0.5 now. If you're a little bit more perhaps sort of critical of this chart, you could look at 2018 to where we are now and say that the ratio now is exactly what it was in 2018. In other words, gold has matched the performance of the stock market over that 6-year period, 2018 to now. Gold has performed just as well as the S&P. And that would probably surprise a lot of people, but this ratio chart tells you that that is correct. And essentially that entire period has just formed a base, and that is a very bullish sign for gold, very, very bullish indeed, because if the S&P hasn't been able to drastically outperform gold over the last half dozen years, that's a good precursor, a good starting point for gold to take over the reins, if you like, and to begin to outperform the stock market. So that would be what we're looking for to fully confirm this capital rotation event, but that is not going to happen without the stock market falling 50%, because the stock market
50, 50.
50%. The stock market fell 50% in 2000. It fell at least 50% in 2008. So during this rotation event, the stock market, the S&P, fell 50% twice. And in this capital rotation event in the 1970s, the stock market also fell by 50%. So you need a 20% drop in the S&P is not going to do it. A 20% drop in the S&P is just a normal, regular occurrence that comes along every few years, but it doesn't give enough scare to the markets to cause a capital rotation event. This will not happen without the S&P falling 50% and the Nasdaq probably falling 80%. Okay, so you know, that is, it might sound shocking to many people, but if we want to see a return or a continuation of a precious metals bull era, that is what we need to occur. We need the rotation of capital from this, on this chart, because it's shown us ever since the 1930s, all the way in the 1970s, the early 2000s, you do not get a precious metals bull era that sustains for a number of years where gold doubles and then doubles again and then doubles again. You do not get that without this chart breaking out. And this chart will not break out without the S&P falling drastically from where it is now.
Okay. Kevin, I got to go back to this, and I'm really hung up on this 50% pullback in the S&P general equities here. That's more than just recessionary. That's almost depressionary. Is that a fair statement?
Well, there's a couple of charts that we perhaps should look at here, and this shows two of them. The two key charts, one overlaid the other. So this is the yield curve inversion. So the green bar chart in the background there, that is the yield curve inversion. It's the 10-year yield minus the 2-year yield, going all the way back to the 1980s there. So what we're doing here, this is literally the 10-year yield minus the 2-year yield, and it would normally be a positive number because the 10-year yield is normally greater than the 2-year yield. The longer you're being asked to hold the bond, the more you should be paid in interest because the greater the risk. And the 2-year yield should be less. But there are times when that flips and the yield curve inverts, and the 2-year yield is a larger number than the 10-year yield. Okay, so that chart shows the yield curve inversion. The inversion is when it's below the red zero line. So it was inverted back there in the late 1980s there. It was inverted in the early 2000s, the early 2000s and 2006, 7, 8. It almost became inverted in sort of 2019 there, and it's very much inverted now. So what does the stock market do when this happens? Well, we can actually see that each time the yield curve inverts and then uninverts, goes back above the zero line, we get a major issue. The early 90s recession, the Asian crisis, the dot-com bust, GFC, great financial crisis, subprime, so that was the financial crisis there. Repo liquidity crisis, which also led into COVID, of course. So some sort of event, some sort of label gets added to this after the chart uninverts, after the graph moves back above the red line. That's a label that we don't need to particularly worry about. We just know that something pretty unpleasant is likely to be heading our way. That's the matrix in the top left-hand corner. I've stolen that from my background in meteorology, and it assesses the likelihood of a major market event occurring in the next sort of 3 months or so, along with the impact of that event. So I'm assessing the impact of the coming event as being a high impact event, hence the check markers in the right-hand column. The likelihood of it happening in the next 3 months is currently medium, 50 to 80%. A high likelihood would be 80% plus. The event itself, or the crisis, whatever you want to call it, can take many months to really fully appear after the yield curve uninverts. So it's not an instant thing, and this is not an exact science. It's a best guess using the weight of evidence as to when this might happen and how severe it might be. So the confidence is high that it's a severe event coming. The when part of it is the tricky part, and it becomes less tricky when the S&P properly breaks down. When we identify a serious breakdown in the stock market, then you know it's heading your way pretty quickly. The stock market, something just to show you here, the black line in the background is the S&P, and I've got it on the log scale at the moment. Sometimes people put it on the linear scale and they start trying to scare you that the S&P is going vertical. Okay, if you hear people say that, look at the scale, because if it's a linear scale, then of course it's going to look vertical, because back in the day the stock market was down at 200. So for the stock market to double from 200 to 400, it barely even registers on a logarithmic scale. Whereas now for the stock market to double, you're going from 4,000 to 8,000. It looks huge. So that's why you use a log scale. Anything that's moved logarithmically, like gold and like Bitcoin and like the stock market, has to be on a log scale. Otherwise, it's meaningless. So now, if I draw a vertical line and I just draw it from the bottom to here, the bottom is at 400, and let's move it to 1200 on the scale there. So that means the S&P has tripled from 400 to 1200. Now, if I move that line over here, wherever I put it, it represents a tripling of the price. So that straight line shows you what needs to happen for a tripling of the price from 2,000 to 6,000. So that automatically makes the entire thing look more reasonable and more sort of less dramatic. So it kind of puts into context the move that we've got at the moment. And there's nothing dramatic about it. It's in context, historic context, is perfectly normal price action for the S&P, and it has not broken down in any meaningful way at all. There's no breakdown on that chart, not even on the small time scales, daily, weekly, monthly time frame. There's no clear breakdown on that chart yet. But you can see that when we get this yield curve uninversion, the stock market tumbles. And during this period here, the stock market went nowhere for 18 months. But here, look at the stock market here from the year 2000 to the year 2007. The stock market went, in fact, all the way over here to 2013. The S&P went absolutely nowhere. So it had 13 years going nowhere. Stock market it fell 50%, it recovered. It fell more than 50%, then it recovered. Then it dropped a bit more, and it took 13 years to recover its previous highs. So this was a capital rotation event. Okay, that was the rotation of capital. And then what happens here, as the stock market plunges, gold can get caught up in that plunge to begin with, and the miners particularly. So gold will probably drop somewhat. The miners will likely drop significantly more, but then the rotation starts to kick in. And as this thing bottoms after a couple of so it started falling in 2000 and it bottomed out in 2002. Before it reached that bottom there, gold was already well on its way, and so were the miners. So gold and the miners begin to outperform as the capital rotation takes hold. And then as the stock market recovers, the stock market's going up nicely, but gold and silver are going much, much faster. And miners have their surges during this period as well. So the miners will move at a different time to the metal, but they will move during this period, during this overall capital rotation event. And there are periods when gold beats the miners, and there are periods when the miners beat gold. And overall, in fact, the gain for gold and the gain for GDX, for example, was similar in this period here. There wasn't a massive amount of difference between the overall gains that gold made and gold miners made, or the gold mining indices. Although, of course, there are individual miners that do much better. But the indices, the GDX, GDXJ, HUI, SIL, they all overall during that 12-year period, they made similar gains, 900%, something of that order. It'd be 900%. Don't quote me on that, but it was a similar percentage gain from start to finish for the miners and for gold. So it can easily take a decade or more once this capital rotation event takes place. The same thing occurred in the 1970s. So we need to look very closely at the S&P chart, which is why I'm keeping a very close eye on the daily chart. This is the daily chart for the S&P, and I put this out on Twitter. I think it was yesterday, and we've got a bearish rising wedge there. Okay, that's been building since when is that? Last year. It was around about this time last year. So about a year, this bearish rising wedge has been in formation. We had a false breakout, which led into a reversal, and then a rapid move back towards the apex. This kind of volatility towards the apex of a pattern isn't uncommon, and the reaction within this orange circle here is going to tell us what comes next, because there are really two scenarios over the next few weeks, or let's say next couple of weeks, in fact. Either we pass through this orange circle in a melt-up scenario, which could take us up significantly higher. There's no way of knowing exactly how high, but in that scenario, stock markets do great, and probably gold and silver and the miners do great as well, taking us to that 2,700 or even higher target for gold. That's the scenario in which we'll be likely to reach 2,700 plus in gold. The alternate scenario is that we get a rejection in this orange circle, and the rejection would be very bearish for the stock market, and that wouldn't be a great thing for the miners or for gold either, or for silver, because the reasons for a rejection here would likely be leading into a broader market issue. So the market issue that I've been talking about in the capital rotation event is either coming very soon, or after a continued melt-up phase. I know the analysts are very sort of split on their views about whether we get a major market melt-up here, or whether this is, the end of the line for the stock market, and we're going to sort of see a plunge. But if I was sort of being held to, or forced to give a view one way or the other, which I think people are probably sort of wanting to know, okay, Kev, that's all great, but what do you think? I think the odds are probably slightly in favor of the melt-up scenario. I think the odds are probably slightly in favor of a stock market reaction, initial reaction to the upside, taking gold to that measured move target in the 2,700 area before a downturn. Gold is stretched on many metrics at the moment. If you look at its distance from moving average, you can analyze gold in all sorts of different ways, but it's becoming quite stretched on its monthly chart. And when gold gets stretched to this degree on its monthly chart, then however much you want to be bullish and expecting $3,000 or more, history has proves that you need to observe the fact that we are stretched. So I think gold is heading towards the point where it's needing to have a significant correction. Whether it's going to happen very soon or a little bit later remains to be seen. Nothing is broken on the gold chart. Gold and S&P are both doing great, and that ratio chart I showed you a moment ago illustrated that. The S&P is in a bull market, gold is in a bull market. Hold both, no problem, until we get a breakdown. If we get a breakdown on the daily chart for gold, and I think that's probably going to need a daily close below about 2,400, that kind of region. And if the S&P shows a breakdown on this daily chart, a definite clear breakdown, then that's when you want to be very, very defensive with your investments, because I suspect
Kevin, what would be your confirmation for a melt up?
Okay, well, a pass through this upper resistance line would do it, and that upper resistance line is looks to me. I'll just put it on the line chart, and I'll place the line as accurately as I can. that's a false breakout. These are confirmed touches. You've got one, there's a second, third, fourth touch on there. So as accurately as you can be, it would involve S&P closing above, probably closing a week above 5,700 and let's say 5,740, 5,750. That kind of region would start to make it fairly clear. If we got a weekly close above 5,750, that's a fairly convincing close. And that is then likely to lead to a move at least up into the 6,000s. Your guess is as good as mine as to exactly how high that might go in a melt-up scenario. But
and I wanted to kind of maybe be the other side of the argument. You said there's probably better odds of a melt up rather than a rejection and a push down. Following a number of other traders and newsletter writers on the macro side that I've been reading, I was trying to look at Tommy Thornton put out a graphic, a chart. It was earlier this week, but basically he said like scenarios, like macro scenarios of how far down would like just a regular pullback be, would a confirmation recession be, what outright depression would be on the S&P, like those targets. And I couldn't go back and find it in time, so I'll try to maybe reach out to Tommy and try to get that. But there are a ton of sell signals going on right now throughout the market and in precious metals, DMARC 13 sell signals, sell setup nines throughout the board. A lot of those people that follow those technicals are just been like pounding the table. Like this is exuberantly high for a number of these signals that are all working together. And so maybe just taking that type of a trader's type TA metrics, I might push back and say, I would say and argue maybe the path most likely would be down. But and I'm not trying to be overly bearish. I'm just trying to set up the other side of the argument here.
yeah, I think it's at a time like this, it's important to have a completely open mind. This ratio chart is the S&P versus ASA. ASA is the precious metals fund that has 50 years of historic data. And when you overlay GDX onto the ASA chart, it matches pretty much perfectly. So this is effectively SPX versus GDX. Okay, so when the chart's rising, the S&P is outperforming, and when it's falling, gold and silver miners are outperforming. So we've got a very clear resistance line that we had a little false breakout there for the S&P. And how many months have we got left here before it needs to resolve? I mean, it's early next year before it's reaching some sort of apex point here where it needs to decide one way or the other whether it's going up or down. Now, I think to answer your question about the S&P, and I'll just take a look at the picture on a larger scale. Let me just see if I can get the S&P without all these annotations on. Let me just clear my drawings and indicators. So on the monthly time frame, and if we're talking about a capital rotation event, a major issue, the previous high at 4818 is major support. It's a support and resistance level just in here at I think it's 4818 if I was to place that line precisely. And for me, any move below 4818, and that would start to become an issue. I'm also going to put on the 3-year moving average and the Ichimoku cloud on here. So you can see back in those in the capital rotation event in the early 2000s, we broke below the 3-year moving average, and then it eventually went below the Ichimoku cloud there. That's this green splodge on here. And the same thing happened again a few years later. Now, at the very least, you need to be breaking below the 3-year moving average. You can see the 3-year moving average is rising, and it's rising up towards that red dotted line that I put on the chart there. So for me, I have no major concerns for the S&P until it moves, well, let's say first below the 12-month moving average, and the 12-month moving average is at 4994, but particularly that region around 4,800. And if we were to see a weekly close below 4,800, then I think we could start talking in terms of this could be the event, this could be it, this could be the capital rotation event beginning. But also that would also require confirmation with a series of other pieces of evidence. But at that time, I would like to see gold moving back towards 2150, 2100. I'd like to see confirmation coming from other ratio charts as this unfolds. I'd like to see gold breaking out versus the S&P. I want to see gold, although falling, I would like to see it falling a smaller percentage than the S&P as time goes on. Otherwise, it's not a capital rotation event at all. So that piece of the puzzle needs to fall into place. But all I can say to people watching this is that the setup is absolutely perfect here for this capital rotation event. We've got an inverted yield curve. We've got an S&P chart pattern that lends itself to an eventual downside resolution. We've got gold approaching an interim target with an ideal downside target in the 2100 area that it is begging to be retested. I mean, a lot of people watching this will think I'm crazy and there's no way gold is going back down towards 2150 or that kind of area. Well, from a technical analysis perspective, that would be an absolutely perfect, picture perfect chart setup to see that happen, to see gold retest that area as the S&P is tumbling, and for the gold to SPX ratio beginning to break out. All those pieces come together, and then we'll be able to say with confidence that I think gold is going to achieve its upside targets of 6,000, 8,000, 10,000, given just a few years. But it's all about capital rotation, and the S&P, as I said, 4,800 area. Any corrections that take place above 4,800 are just normal, everyday, nothing to worry about. I think you might have your mic off there, Trevor, by the way, sorry.
Oh, sorry. I was just laughing. I said, nothing to worry about.
Well, 4,800, I'm saying nothing to worry about, in terms of how it's going to impact the medium term for the S&P. I'm talking, what I'm talking about here is a 10-year hiatus for the stock market. I'm not talking about, S&P dropping, 600, 800 points over the course of a month or two, and then regaining that over the course of another month or two. What I'm talking about is a lost decade for the stock market, where the S&P falls 50%, NASDAQ falls 80%, and gold goes to, well, pick your number, let's say $8,000 plus. That's what I'm talking about. So, that process is not enacted without S&P falling below 4,800.
Okay, we're going to be following closely. Kevin, I'm going to leave it at that because that's a lot to intake. I think I'm going to go back and actually listen to this and watch this multiple times in next coming weeks. And I hope everybody who is also listening and watching will revert back to this. And there's a couple of key points in all those charts here that he just shared. We're going to make this, I think, this week's long form. We're going to post it up on the YouTube channel. If you are listening to it on the podcast network, then I would advise you to go back to the Mining Stock Daily YouTube channel and watch the video as well, where you can see the charts and watch Kevin interact with those charts. It's meaningful. I think we are in a very pivotal period here, whether it's something on Friday with Jerome Powell into September with potential rate cut cycles, or even just another heightened volatility season here. Kevin, there's a lot to take in and consider, and you're right. Consider all sides of the debate and which direction this thing's going. Thanks so much for your time. Sorry about the technical difficulties to get started, but let's touch base here in the next couple of weeks and see how things are playing out.
Good stuff, Trevor. Good to talk.
Thank you.